Let's talk about shares of Morgan Stanley now. They're in a bear market. However, Oppenheimer believes it is a good time to buy for the long term. Stock's getting a nice bump today. They reiterate their outperform rating on the stock. We've made it our call of the day. It fits perfectly into the broader market context, guys. Weiss, so the headline, not the same company as in '06. They do a deep dive. They upgraded the stock back in October. They said it was in the middle of earnings season, had very little to do with the actual results, and almost everything, they say, to do with the fact that the stock was down from $59 in March, even though the fundamentals were good.
Well, first of all, the analyst, Chris Kotowski, was a former partner of mine. I've known him for over 20 years. He's a phenomenal analyst, great stock picker, and very conservative. So it takes him a while to get to something. He's got to dot all the I's and cross the T's. It makes sense. So Morgan Stanley, Gorman has done a job I didn't think he could do. Basically, I was skeptical of it, and he's executed brilliantly. So you've got a wealth management firm. However, here's my caution. My caution is that a lot of the wealth management revenues over the last number of years have come from their lending book. And as rates go up, that's going to hit their lending book somewhat. So you also have other issues with continued compression on fee management. So if you want to pick a winner in the group, they're the winner. The question is, do you want to be in the group? So that's how I look at it.
That's the $64,000 and a heck of a lot more money question.
Yeah. We want to be in the group. I mean, when you look at the...
You are in the group.
When you look at the wealth management stocks that are out there, a couple things come to mind. Number one, as volatility ticks up, trading revenues are obviously going to tick up. And one of the things that a lot of people may not pay close attention to is the fact that these wealth management firms make a lot of money off of the cash that their investors hold. And if we're getting to the point where people start to, increase allocation towards cash, and they go from maybe a 1% to a 3% allocation for their clients, that is a lot of additional revenue that they're making off that cash.
Well, that said, though, that hasn't really helped Schwab over the last year. I mean, that's been a thesis. Right. I happen to agree with you on Morgan Stanley. I'm just not so sure on the cash management. I think if you really want a thesis on this, you've got to predict that the stock market in general, globally, is going to be up 10, 15% over the next 12 months. Because if that happens and the assets under management appreciate accordingly, you're going to see this stock, along with its revenues and earnings per share, just skyrocket.
You can't buy a financial stock unless you think
no, that's
the
not what
stock
I'm saying.
market's going to be up 10,
That's not what I'm saying. I think you can.
Because that's what you just said.
That's what he said, Scott. I'm with you.
No, that's not what I said.
Well,
Okay, and you know I own Goldman Sachs, all right, which is a competitor. So you know I'm in the space. What I'm saying though is, if you want a thesis for why this stock skyrockets, a 10 to 15% stock market rise over the next 12 months, which most people aren't really thinking about, that will propel revenues, return on equity, book value, everything for this stock much, much higher. As it is, it's cheap. But what moves it higher? I don't think it's the cash management fees. I'm sorry, Mark. But a rising stock market is what moves this higher.
Well, I think it's the business model that has moved it higher. People forget this is a stock that in 2016 was $21. So this stock has endured the normalization of rates being moved higher by the Federal Reserve. Its wealth management business has recreated itself. It has taken a tremendous amount of volume away from the other players in the space. It's also benefited from Goldman Sachs kind of restructuring who they are. They're picking up areas, in particular equity offering. They're the leader in that right now. So they're picking up some volume from the Goldman Sachs structure. They're picking up volume from the other wealth managers. And I think Morgan Stanley is well positioned, whether the market goes higher or lower, as they move to the next 3 to 5 years.
But I think also that as an investor, you have to look at as a basket, do you want to own financials, right? Which is a great question. When you look at J.P. Morgan versus a Morgan Stanley over the last few years, there's been no challenger to that, right? J.P. Morgan's been a best in breed, and so I think the analyst makes great comments, but ultimately, what's going to cause Morgan Stanley to catch up with J.P. Morgan's of the like? Because as an investor, if I can invest in one, I still think that's the question you have to answer. Yeah. Which one would I buy?
In 3 months, J.P. Morgan's done nothing. I mean, if it's a proxy somewhat for the space itself, you need to see that stock pick up before you can have any confidence overall. Maybe they're not going to all move in tandem.
Bank's challenge. I saw you sold Citi. I sold a chunk of my Citi yesterday. I had upsized it significantly, a little lower, so just took advantage of that. And I'm looking forward to getting out. My original price target was 74. Here's why they're challenged. You've got a flattening yield curve, which seems to be in perpetuity. I don't see rates running away from us because of the challenges in the other parts of the world. And you're going to need that. And the businesses they have, well, loan growth has been slowing down, and I think that's going to continue. So you've also got, on the other side, you've got these alternative lending vehicles, direct lending funds, BDCs, et cetera, that have really hit their business.
I think J.P. Morgan, which I'm long, has traded very well in this quarter, given the turmoil and the volatility.
No
in
issue,
the markets.
no disagreement.
I think it is best in breed, and I think it continues to prove itself in that class. And I think there are other financial institutions that you can invest in. I just don't understand why it's a binary decision to invest in financials based on where the market is. American Express. I'm long. American Express has been fantastic.
Yeah, but I mean, I think we're talking about like big sort of money center banks, like the big financial stocks we always talk about.
I think also their wealth management division.
I would agree with
that's
the point Jim's making. I don't think Jim's talking
is
about
really where you
AXP.
need exactly the wealth management divisions where you're going to need a tailwind there versus the other areas that don't have those large wealth management groups can pivot, I think, a little bit more in a choppier market.
So let me tell you where I added exposure.
And then Mark after.
So I added some more Visa, right, last week. I actually added a little this morning, and I bought Global Payments. Now, they're not banks, but they do have some credit risk, Global Payments more so than Visa. But to me, that's where financials are going in fintech. So I think Visa, to me, I can make a lot more money in it than I can in the money center banks. And, you know, I'd just rather be there.
Therein lies the story, right? Yeah. That's part of the point of what you're making.
And before we leave the financial conversation, the underperformance of regional banks. I mean, we all, myself included, talked ad nauseum over the last 18 months about the opportunity in regional banks, given the orientation to focusing on a domestic economy. We thought it was going to be regional banks that are outperforming. Regional banks are underperforming now the rest of the financial space. And I think back to your comments before about economic behaviors, what is that telling you about the economy when regional banks are struggling as significantly as they are?
I do want to introduce a question that we're getting from a viewer because it plays into the conversation. It's on Goldman Sachs. Wilson in Nevada, thank you very much for the question. How long until Goldman hits 250? Where are we at now? Let's throw up Goldman Sachs. We'll look at it today. It's
192.
192.
Yeah. Before it goes to 250.
Ooh.
You know, obviously, there's a scandal they're facing. We don't know what the liability is.
I mean, you buy it here?
That's going to hang over them.
Down 19% in 3 months?
The answer is why? You know, it's still a very well-run business. Now, we don't know what the new CEO is going to do, how he's going to run it, but it's still a quality franchise. They've managed through a lot of issues and come out tops on it.
I think a lot of it depends on your time horizon. I mean, it hasn't been a good performer. In order for it to get to 250, I mean, that could be 3-4 years down the road, especially with the yield curve being where it's at. So, you know, I think J.P. Morgan is a much better option, and we like Morgan Stanley as well right now.
I would buy Goldman Sachs, but I'd buy it on the other side of the new year.
The problem with Goldman Sachs is sentiment right now. Okay, it's all about the 1MDB scandal. It's also about tax loss selling in December. I know not every investor is a taxable investor. The fundamentals of Goldman Sachs are as good as Morgan Stanley, in my opinion. The things that will propel Morgan Stanley higher will propel Goldman Sachs higher. But the problem is there's such a negative narrative right now. So the question is, what changes the narrative? Frankly, nothing until you get the next earnings report, which is over a month away. Nothing's going to change that narrative.
I think you can definitely, I think you're going to begin to see a movement from a lot of the passively managed funds, index funds, which have done awesome since 2009, towards more of these actively managed funds. And I think that could be a tailwind for a lot of these asset management firms.
So if you get a pickup in overall volatility, maybe you'll be right.
Yeah.